once you read the scenario. So the required states disclose the property, the investment property note, and the profit before tax note. So there are two notes that we have to disclose here, right? The investment property note and the profit before tax note in in Snake's financial statements for the year ended 31 December 20x5. So we know that the year ends on 31 December 20x5. So that is one item that you would have to highlight. All right, that is something that you'd have to highlight, that the year end is 31 December, and we have to highlight these two items: profit before tax note and the investment property note. You should ignore tax and comparative amounts. So you don't have to have a column for the prior year because you're not going to show comparatives, and ignore tax. We're not going to look at VAT. We're not going to look at any deferred tax. All right, so it's just a clear, a straightforward question that deals with investment property. Now, let us just talk about the profit before tax note. What is it? A profit before tax note is a note that shows you any income or expense items that will be included under the profit before tax note. Now, if you go to the presentation of financial statements, IAS1, it mentions some items that might have to be disclosed separately. But for our purposes, what we need to know would be our income and expenses that relate to our investment property. So the income here, for instance, would be your rental income that you receive from the investment property, and your expenses would also be any expenses that relate to those investment property. If we look at the example, there are items such as rates. All right, so that would be included in your profit before tax note. And then we'll also have depreciation. Depreciation is another item that would appear in the profit before tax note. So we're just listing those expenses. I would recommend that you just go and look at IAS 1 presentation of financial statements, and you look at the disclosure and you look specifically under your profit before tax note just to read the items that can be disclosed or shown under the profit before tax note. Okay, so let us read the scenario now. Snake Limited is in the construction industry. It constructs buildings for resale, for leasing, and for private use. All right, so now when we talk about buildings for resale, how will those buildings for resale be classified as? Those buildings that are constructed for the purposes of resale, what will those buildings be classified as?
Inventory.
Inventory,
Stock.
exactly. All right, and then we have buildings that are constructed for leasing purposes. How will those buildings be classified as? Those buildings for leasing purposes?
Investment
Uh,
property.
yes.
Investment property, exactly. And then the last one, buildings for private use, would be PPE. So they have all of these buildings. Some are classified as inventories, some are classified as investment property, and some are classified as owner-occupied property, which would be property, plant, and equipment. So when you're reading the question, just bear that in mind, that they have different buildings and those buildings are classified differently. So, right, a building that Snake Limited had constructed in Cape Town for sale in the ordinary course of business at a cost of 800,000 had been on the market for 2 years and was still not sold. How would you classify this building, the Cape Town building, constructed
As
in Cape Town? Inventory,
Yeah.
exactly, because it was constructed for the purpose of sale in the ordinary course of business. So this building was inventory. Now let us go to the second paragraph. On 1st of March 20X5, Snake Limited took it off the market and instead leased it to tenants. Its fair value was 1.5 million on 31 December 20x5 and 1 million on 1st of March. All right. So now you must think in your mind. We had a building that was classified as inventory, but now it is going to be leased out to tenants. So there's a change of use in this property. So we are changing the use from inventories to um
IP
you're changing
investment property.
exactly you're changing the use um from inventories to to investment property. So what is important, since you've identified, you can even write down on your question paper, this is inventory to investment property. And then you know the rule. What does the rule state? Inventory is you measure inventory at the lowest cost of net realizable value, and then you're going to transfer it at its carrying amount. All right. So let us read the next one. All right. Is there, I have to admit someone. Okay, I'll just admit this person. All right. Next we go ahead. The fair value of the building in Bloemfontein. The fair value of a building in Bloemfontein, it has always been leased to tenants, has never been determinable. The building was completed on 1st of January 20x2 at a cost of 5 billion. All right, so on 1st of January 20x2, we have a cost of 5 million. A cost of 5 million. Now it tells us that the fair value was never determinable. All right, it hasn't been determinable. What happens in this instance? We go back to the theory. Fair value was never determinable.
We
What does
use
the
the cost. Yes, it
ex
answer.
all right, we use the cost. We use the cost, and it doesn't matter if the fair value is determinable in the future. You would always have to carry this property at its cost price, and you're going to depreciate the property, but you're going to use a nil residual value. All right, so we're told its total estimated useful life is 10 years. All right, so this we also need to know. It's very important for us. The useful life is 10 years. Fair values are now considered possible, and the accountant is adamant that the asset should either be measured under the fair value model forthwith, or that the depreciation of the building should be measured using an estimated residual value of 1 million. Previously, the residual value was nil. The estimated useful life has remained unchanged, and the fair value on 31 December 20x5 was 9.8 million. So the accountant is adamant that you must use the fair value model and that you should use a residual value of 1 million. But we know that in this instance, the accountant is wrong, because the standard tells us that if at initial recognition, you were unable to determine the fair value, that this property will always be measured at its cost price, and that the residual value will only be nil, even though later, at a later date, we were able to determine the fair value. All right, so I'll not highlight anything else because it's irrelevant to me, because we know that we will just use the cost price, and we will use we'll depreciate it over its useful life of 10 years. All right, you see why it's very important for you to understand the theory, so that when you come to a question, you can easily apply it. So let us go to the fourth paragraph. On 30 September 20x5, Snake Limited leased its old head office building in Durban to a tenant. All right, just that first sentence. What we determine from that first sentence?
There's been a
Change in use.
transfer of use.
The,
Yes, changes.
yes,
Change in use.
change in use. What is the change in use? From what to what?
Uh, PPE to investment property.
Exactly. All right. So you get it. There's a change in use in this property. From PPE, it becomes investment property. So let us highlight the date of the change in use. That is 30 September. Okay. So it leased the old office building. We know, okay, it leased the office building to a tenant. The original cost was 4 million. It was acquired on 30 September 20x3, on which date the total useful life was 10 years and its residual value was nil. Okay, so we need this information. Original cost was 4 million. And then we have a useful life of 10 years. That's the useful life. Residual value was nil. All right. The fair value was 3.7 million on 31 December 20x5. So we'll need this one. Fair value on 31 December 20x5 was, okay, which is 3.7 million. That's fine. And then the fair value on 30 September, fair value on 30 September was its carrying amount, was equal to the carrying amount. All right. So this is a property in Durban. It's old. It lists an old head office to Dermot. All right, the last one, the last paragraph on 30 September 20x5, Snake Limited evicted tenants from a building in Joburg and instead moved its head office into the building. All right. So now again we have a change of use where we have tenants are evicted from a building in Joburg and Snake Limited then occupies that building. So again, we have a change in use, but in this instance, a change in use from investment property to, from property, plant and equipment to investment property. All right. On this date, the fair value was 4 million and remaining useful life was 5 years and the residual value was 500,000. Okay, so remaining useful life was 5 years. Remaining useful life was 5 years and their residual value was 500,000. The fair value of the building was 3 million on 31 December 20x4. 3 million, all right, on 31 December 20x4. So
Sorry,
this
sir.
question, yes?
You said on the 30th of September 20x5 they changed there's a change in ownership of from investment property. You said from PPE to investment property,
It's from
but it's
investment
from
property.
invest to
Yes.
PPE.
Yes, exactly. Sorry, that was my mistake. It was investment. It's a change of use from investment property to PPE because there were tenants renting it out and now Snake Limited moved into the building. Then we have additional information. The following information is relevant. All leases were operating leases. So it just means that the property was not rented out for its entire useful life. All right. So it's an operating lease. It comes to an end at some point in time. Rentals earned from the investment property totaled 2 million and then rates paid totaled 1 million. Snake Limited applies the fair value model to investment property. All right, so this is very important. Fair value model to investment property and the cost model to property, plant and equipment. All right, so we're given a lot of information. This example is quite long. It would probably take you an hour to do this question. All right, maybe it might take shorter because things like profit before tax note would be very short. So how would I do it? I would do my note first for the profit before tax note, because for the profit before tax note, I know I'm only going to show any income. I'm going to show expenses. And here we're given the income. We're given income, rental income that was earned from the investment properties of 2 million, and we're given rates. So that's an expense that you'd show in your as part of your property plant and as part of your profit before tax note. All right, so I just want to show you the profit before tax notes, and then I will come back to and we will deal with the example. Where is this? All right, let me share my screen. Okay, so let us look quickly at the profit before tax note. So the title, you always start with the name of the company. This is Snake Limited. Extract from the notes of the financial statements. Okay, this is not really necessary, but it's just for full presentation, and it's for the year ended 31 December 20x5. So profit before tax, you have to show the year. Profit before tax is stated after showing the following. So as I mentioned to you, you'd show your income and your expenses. The income we were given, rental income from the investment properties, 2.2 million. That was given. So you'll already earn a mark there. And then expenses, we have our property rentals, which are rates, and we're given the amount of 1 million. And now the others, depreciation and we have not yet calculated depreciation, so we cannot present that. All right, so let us go and deal with the rest of the question. So the question stated, you should provide the profit before tax note, and you should also provide the investment property note. Okay, so you see the profit before tax note, there are only 4 items. All right, the rental income and the rates and then depreciation. The first 2 were given to us, so you can easily earn your marks by putting them there. But depreciation we will have to calculate. Okay. Now let us go and deal with the question. Now, since we had a lot of items in this question, we have to look at it one by one. And what this question did is that it divided different properties. All right, it divided different properties. First, we had a property in Cape Town. That was the first property. Then we had a property in Bloemfontein. And then we had another property here that was given, a property in Durban. And we had a property in Joburg. Okay, so let us deal with each property separately first of all. I will open an Excel workbook. Okay, so let me close this one and go back to the question. All right, so a building that Snake Limited had constructed in Cape Town for sale in the ordinary course of building. So you would have already written down that this is a change of use from inventories to investment property. Okay, let me do my workings here. So we know, let's just say Cape Town property. Okay, this is a change in, we know this is a change in use. We would have already written that. So this is inventories to investment property. Okay. So this building was acquired at a cost of 800,000. It had been on the market for 2 years and it was still not sold. On 1st of March, Snake Limited took it off the market and instead leased it to its tenants. Its fair value was 1.5 million on 31 December 20x5 and 1 million on 1st of March 20x5. Okay, so let us deal with this. If you're going to do this, we know that this property as a change in use, it changes from inventories and it becomes investment property. And it looks like it's the only property that actually had a change of use. It looks like it's the only property that actually had a change of use. We don't have other information so far. When I'm talking about the change of use, the only property that had a change of use from investment properties, from inventories to investment properties. Okay. So let us look at this. What would be your journal? Journals were not required for this question, but what would be your journal entry? What would be your journal entry for this building? Let us deal with our journal entries. What would be our journal entries on the 1st of March? Anyone?
Credit inventory and debit investment.
Credit inventory and debit investment property. All right. So let me just do journals here. We're not required to do this, but this will help you. You can do this as part of your workings. So we had one on 1st of March, 20x5. Okay, I'll just say 2015. We had, so you said we debit our investment property. Okay, I'll just write IP. Yeah. We debit our investment. Let me put the debit in Namibian dollars. And then we credit our inventory. Okay, create inventories. This will be, we'll have a credit column. And that's also in Namibian dollars. And how much is the amount? How much is the amount?
1 million. Oh. You know 1 million, sir.
All right. It is, remember, inventories are carried at the lower of cost or net realizable value. And then the standard tells us when you're going to do the transfer, you're going to transfer the inventories at its carrying amount. So the carrying amount at the inventories, we're not given a net realizable, we're not told that the net realizable is lower. So we just use the cost price of 800,000. So the amount here will be 800,000. Sorry, I made a mistake here. I should actually have done this. Okay, the amount is 800,000. 800,000 in both instances. Okay. Let me just make this accounting. We still haven't answered the question, by the way, so you won't get marks for this. But these are important workings. Now I can highlight this part. I'll highlight that 800,000 because I know that I must use that 800,000 in my investment property note. All right, because we're showing that there's an 800,000 on 1st of March. So that's actually an addition. It's an addition for the year. But then let us go back and see. We are told that its fair value on 31 December was 1.5 million and it was 1 million on 1st of March. So there are fair value adjustments that we have to make. All right. So we transfer it first to investment properties, but on the same date, once it's transferred, we have to now carry the investment property at its fair value. And how do we know that we carry the investment property at its fair value? It tells us that Snake Limited applies the fair value model to its investment properties and the cost model to its property, plant, and equipment. So we have to do an adjustment to fair value on 1st of March. And we're given the fair values on 1st of March. What was the fair value on 1st of March?
1 million.
1 million. All right. So what is the journal entry for the fair value adjustment? Is the investment property increasing or decreasing in value?
Decreasing in value of 500,000.
No, on 1st of March. On 1st of March. Remember, we transferred it to investment property at an amount of 800,000. But at that same date, that investment property should actually be 1 million. So in this instance, it is increasing in value on the 1st of March.
Yes.
All right, so on the 1st of March, it's increasing in value to 1 million. So the adjustment would just be 1 million minus your 800,000. These are just the workings. Obviously, this you can do in your head. You don't have to show it. But if it's wrong, then we have a 200,000 increase. We debit our investment property by 200,000, and then we credit our fair value adjustment. Sorry. The fair value adjustment there was 200,000. Is everyone with me up to here?
Yes, sir.
Yes, sir.
All right.
No.
Okay. Yes, you have a question. Go ahead. What is your question? The one
So
that.
Why are we subtracting the 800,000?
Okay, we want to know the value of the building has increased to 1 million, right? So we want to know by how much has the value been increased. So we have, if we do, we can do it in this way. The fair value on 1 March 2015. The fair value on 1 March on 2015 is 1 million. Okay, let me put that there. However, so we know that our building must be measured at 1 million, but currently the building is being measured at its cost price, and the cost price is 800,000. So what is the difference between the two? The difference between 1 million and 800,000? The difference between 1 million and 800,000 is the 200,000, and this is the amount of a fair value adjustment. So this value is the value at which we have to increase the investment property by to get it from a value of 800,000 to a value of 1 million. Are we together? So we just want, all right, great. So we're together up to there. Okay. And then again, we are told on 31 December 20x5, the fair value is 1.5 million. Again, this property has increased. It has increased. I'm not putting narrations for now because I'm not even answering the question. These journals are not part of the question. So the fair value of the building has increased from 1.5 million. I mean, it has increased from 1 million to 1.5 million. So we have a difference of 500,000. So we'll have to put a journal entry for 500,000. Why am I doing this? I'm doing this because I want to show you that this, all of this that I'm highlighting in yellow, this will form part of our investment property note. All right. Because all of this part where I debit investment property, it means there's a change in our investment property. Are we together?
Yes, sir.
All right. So let us go on. That was the first property, the one in Cape Town. Let us look at the next one. And this property, this property is investment property at fair value. This would be our investment property at fair value. All right, so all this property, investment property at fair value. Okay, let us go to the next one. The fair value of a building in Bloemfontein, it has always been leased to tenants, has never been determinable. So for this one, we know that this is investment property at its cost price because we said investment property where at the beginning you did not know the fair value of should always be measured at its cost price. And I think this was the only investment property that was actually measured at its cost price. And so let us look at this. The fair value of a building in Bloemfontein, it has always been leased to tenants, has never been determinable. The building was completed on 1st of January 20X2 at a cost of 5 million and its estimated useful life is 10 years. All right. The rest I didn't highlight because we just consider that unimportant. All right, or it's not important for us. Okay, so what happens to this building? This building has always been leased to tenants. So this building, we know that this building is an investment property. It was always leased to tenants. So what we know about this property is that this property must now, it should always be shown at its cost price. It must always be shown at its cost price. So let us do the workings. We can actually show that building. Okay, this Cape Town property, I'll leave these workings because I did the journal entry. So the next one that I have is the Bloemfontein. How do you even spell that? I don't know if this is the correct spelling, but anyway, let us do the workings. This property must be measured using the cost model, and the cost model is just your cost, which is 1.5. What was the property? On 1st of January,
5 million.
it was bought at a cost of 5 million. All right, so it's 5 million. 1st of January 20X2, it was bought at a cost of 5 million. All right, let's just put the date there. This was 1st of January. I'll say 2012. Okay. Now it was bought in 2012 and we are now in 2015, right? We are counting for the year end 2015, right? 31 December 20X5. We'll just say that's 2015. So this property would have been depreciated. For how many years would it have been depreciated at the beginning of the year? So we'd have to calculate depreciation from 1st of January 2012 to 1 January 2015. What is our depreciation for those 3 years? That would be 5 million, right? Divided by what is the useful life?
10
10
years.
years. 10 years. All right, we divide it by 10 years and we'll get an amount of 500,000 per year, isn't it? And this asset has been depreciated, this property has been depreciated for 3 years. So it's 5
3
million
years.
divided by 10 times 3 years. So this amount, this is our accumulated depreciation at 31 December, at 31 December 2014. That's our accumulated depreciation, 31 December 2014. So we're depreciating for 2012, 2013, and 2014. So that's a accumulated depreciation at the beginning of the year. We can even start in this instance to actually show that note. Okay, I want to do this. I want to display it for you here. because we are running out of time. I want us at least to finish this property. Okay. View, normal view. Okay. So this is Snakes Limited note to the financial statements for the year ended 31 December 20x5. I put 2015. So we have our investment property note. Now the investment property note looks exactly like the property, plant and equipment note. So we have our, for this note, since this investment property is carried at its cost price, it will always be carried, and the fair value was not determinable at the beginning. It will always be carried at its cost price. So what are we reconciling? We're reconciling the carrying amount at the beginning of the year, which is your 1st of January 20x5, to your carrying amount at the end of the year, which is your carrying amount at 31 December. Where is the at 31 December 20x5. All right, so we're reconciling those two. I can just hide all of these. I can hide these. Okay, so let us look at the property. We started with the cost of 5 million. We calculated our accumulated depreciation in our workings. We got to an amount where our workings. Got to an amount of accumulated depreciation of 1.5 million. So your 5 million cost minus accumulated depreciation of 1.5 million, we arrive at a carrying amount of 3.5 million on 1st of January 20x5. Now this property didn't have any other movements. The only movements that we have is our depreciation for the year. And the depreciation for the year is just your 5 million. That's your 5 million divided by 10 years, you will arrive at an amount of 500,000. That's your depreciation for the year. So we put our depreciation for the year, 500,000, and we arrive at a carrying amount at the end of the year is 3 million. So that's your 3.5 million at the beginning of the year minus your depreciation for the year, 500,000. Your carrying amount at the end of the year should be 3 million. Your summary, your cost price didn't change. You always had this property. It was 5 million, the cost. But what is your accumulated depreciation now at the end of the year? It's your accumulated depreciation at the beginning, 1.5 million, plus your depreciation for the year. So your total accumulated depreciation is now 2 million. 5 million minus 2 million brings you back to your 3 million. So in this instance, we have finished this property, and this was the only property that was measured at using the cost model, because we know that this company has chosen to use the fair value model, but the standard tells us that where the fair value model, where fair value is not determinable at initial acquisition or construction, as was in this instance, you will always have to classify this investment property at its cost, all right, using the cost model. Are there questions? Are there questions? All right, it seems that you don't have questions. So I want you to finish the rest of the properties, those properties that are carried at the fair value model. So where's the question? Finish the rest of the properties, and tomorrow I will go, and that will be our starting point. We will deal with the rest of the note. All right, we'll deal with the rest of the note tomorrow. Okay, so see you tomorrow then.